I recently got a DM asking me to make a video about my trading strategy. Now, I've actually purposely been avoiding making a video about this. Not because I'm stingy and I want to keep my secrets to myself, but because it's really hard to explain the strategy that I use. Because it's a combination of indicators and discretion. And I think it's better to show you than it is to tell you. But with that being said, I'm going to bite the bullet. So in this video, I'm going to talk to you about all the indicators that I use. Let's get straight into it. Hi guys, I'm Enny, aka the Knock Trader, your friendly neighborhood swing trader, back again with another video. Remember to hit that like button, hit that subscribe button, and hit that alert button to get alerts on all my latest videos. I've got Facebook, Twitter, and Instagram.
A few moments later.
So what are trading indicators? Well, trading indicators are mathematical calculations which are plotted as lines on a price chart and can help traders identify certain signals and trends within the market. And there's two main types of indicators. You've got your leading indicators and your lagged indicators. Question time for you guys. Is Fibonacci a leading or lagged indicator? I'm going to give you the answer at the end of this video. So what is a lagged indicator? Well, as the name probably suggests, a lagged indicator helps to confirm in progress trends by using calculations that follow price action. So the MACD, Bollinger Bands, and moving averages are all examples of lagged indicators. So for example, here we have the MACD and price. Now the MACD showed that the MACD crossover shows when price is potentially about to change direction, but it's lagged. So while price changed direction on about the 10th of December, it took a further day or so before the MACD actually presented the case that it was going to cross over. So as you can see here, while the MACD is a sign of a change in direction, it often trails the actual change in direction by price, so which is why it's called a lagged indicator. And then we have leading indicators. So leading indicators help to predict future trends by using shorter periods in their calculation. So two examples of leading indicators are the RSI and stochastic. As you guys know, I use RSI religiously, and RSI stands for Relative Strength Index. So if I use the exact same stock, which is Ashted Group that I used for my previous MACD example, I'm going to use for my RSI example. As you can see here, this horizontal line denotes where the MACD crossover was. So I'm going to get a horizontal line and denote where the RSI shows a sign of being oversold, which is a sign to normally buy. Now, as you can see here, this green area shows where it was oversold, and it actually crosses with the exact point at which price reversed and started going up. So it's easy to see straight away that the RSI is a leading indicator. As you can see here, the point at which the RSI gave a signal for it to be a buy, it was the exact right point for it to cross over. Now, this is not always going to be the case. I'm going to go through this a little bit further as to why a leading indicator, being a better indicator in terms of change of direction, might be good for some reasons, but might also be bad for another reason. So you should never use any one indicator in isolation. But this is just to show you the difference between a leading and a lagged indicator, in the sense that a lagged indicator takes some time to show the signals that you need, while a leading indicator will show it sooner. So here you have it, guys, the secret sauce, my Knock Trader indicators. This is probably of no surprise to anyone that watches my technical analysis reports or my live streams. I'm transparent with the indicators and that I use. So for my lagged indicators, I use MACD and moving averages, which are the exponential moving average and simple moving average. And for my leading indicators, I use RSI, which is Relative Strength Index, and Fibonacci. So for those of you who said Fibonacci was a leading indicator, well done. 1 point for you. So let me return once again to this chart. So this orange line is the 180-day simple moving average. The purple line is the 15-day exponential moving average. This is the MACD. This is the RSI. And then Fibonacci I use here, but I use it sometimes sparingly. It's not going to be on the chart all the time. So as you can see, I use a combination of lagged and leading indicators, and this is by design. There's a specific reason why I use a combination of both. I know you're probably thinking to yourself, why don't I just use leading indicators? Because they're more responsive and they give buying or selling signals quicker than lagged indicators. Well, there's a primary reason why you need a combination, well, I think you need a combination of both lagged and leading indicators in your trading strategy. There's a really great article on baby pips. I think you should check it out. So I found a great article by Baby Pips on leading and lagged indicators. It talks about what they both are and the weaknesses in both individual types of indicators. So a leading indicator gives a signal before the new trend or reversal occurs. So it tells you what's going to happen before it happens. Well, that's what it's supposed to do anyway. A lagged indicator, on the other hand, gives a signal after the trend has started and basically informs you, hey buddy, pay attention. The trend has started, you're missing the boat. So they go on to say, so you're probably thinking, oh, I'm going to get rich with a leading indicator. Well, that's what I thought as well. The one problem with leading indicators is that when you use a leading indicator, you'll experience a lot of fake outs. So what that means is that while the leading indicator may tell you to buy, for example, it may be a fake out, meaning that even though it told you to buy, the price might still sell off and then you end up in trouble. They go on to say, leading indicators are notorious for giving bogus signals which could mislead. However, lagged indicators only give signals after the price change is clearly forming a trend. But the downside to lagged indicators, as you could probably guess, is that sometimes you're too late to the party by the time you've seen the signal. So this article comes to the conclusion that while the two can be supportive of each other, they're more likely to conflict with each other. See, this is where I disagree. Because both leading and lagged indicators have their shortcomings, when you use them in tandem, I believe that you can mitigate the fake outs caused by leading indicators and the late entries caused by lagged indicators, and you can find a strategy that pairs the benefits of both so that you can catch trades at the right time without being caught on fake outs. So given the information you now know about MACD being a lagged indicator and RSI being a leading indicator, you must understand why I like to use them together. If I just gone off the information of the RSI, then I could have potentially been entering during a breakout and it could have sold off some more. But if I'd entered with the information of the leading and lagged indicator, I could have a better informed decision as to whether to take a position based on the fact that both of them are telling me the same thing. Because if they're both telling me the same thing, then there's more likelihood that then it's not going to be a fake out. I hope this kind of makes sense. So I use the leading indicator to kind of confirm if a reversal is happening, and then I use the lagged indicator and the motion that's going to make sure that this leading indicator isn't a false breakout, and it also shows me the same signs of a reversal. So this is part one of my two-part video on indicators. I hope you found this useful. It's Any, aka the Not Trader, signing out.